Plug Power is currently trading at exactly $2.64 per share as of the market close on Thursday, July 2, 2026, holding steady with heavy accumulation keeping the stock anchored near its daily open of $2.68, despite experiencing an intraday low of $2.51 and an intraday high of $2.80. If you are tracking this volatility on your preferred trading app or charting platform, what you are seeing on the surface looks like standard clean energy turbulence, but beneath that calm exterior lies a major structural shift that retail traders are completely missing. While the broader public assumes this company is just another struggling clean energy stock bleeding cash, institutional trading volume tells a drastically different story, because the stock was recently shifted within several Russell indices from value to growth benchmarks, signaling that big institutional players are positioning for an entirely different financial narrative. This index reclassification happened right alongside a massive operational milestone in Europe, where the company completed the commissioning and handover of its 5-megawatt GenEco proton exchange membrane electrolyzer system at the MOD facility in Denmark, proving that they can scale physical infrastructure even while Wall Street debates their balance sheet. The prevailing market sentiment around this asset is simple. Most retail investors look at the historical destruction of capital and assume the company is heading toward perpetual dilution or worse. This perspective makes total sense if you only focus on past performance, but challenging that assumption reveals a massive gap between public perception and operational reality. If you look closely at recent performance data on major platforms like Fidelity or Interactive Brokers, you will see that the company delivered a massive first-quarter earnings beat, with revenue surging over 22% year-over-year to more than $163 million, which beat Wall Street expectations by $20 million. The real story isn't just top-line growth, it is the massive 71% improvement in GAAP gross margins, which jumped from negative 55% to negative 13% in a single year. That is a massive operational step change that completely alters the underlying math of the business, yet the stock remains pinned under $3 because the market is demanding absolute proof of profitability before it re-rates the equity. When you look at the daily price action, the trading volume has been consistently elevated, hovering near 60 million shares a day, which indicates aggressive accumulation and distribution happening right at these lows. This massive volume is tied to major strategic decisions, including a recent $44 million federal investment tax credit transfer for their St. Gabriel hydrogen facility, which shows management is actively finding creative ways to strengthen liquidity without relying solely on public equity offerings. People tracking clean tech on modern online investing sites or through a Robinhood account often get distracted by the daily 5% swings, but the institutional activity shows a concentrated bet on the company's stated goal of achieving positive operating income by the end of 2027 and total profitability by 2028. This long-term projection creates an intense tension because the short-term cash runway is still tight, meaning the company is essentially in a high-stakes race against time to scale its production network before its current capital reserves run dry. To truly understand what this company does, you have to look past the stock ticker and look at their actual business model, which centers on building an end-to-end green hydrogen ecosystem. They don't just build fuel cells, they manufacture massive industrial electrolyzers, build out hydrogen storage infrastructure, and operate a domestic liquid hydrogen production network across states like Georgia, Tennessee, and Louisiana, giving them a real-world footprint that can supply dozens of tons of fuel per day. Historically, the company made its name by replacing traditional batteries in forklifts for massive retail warehouses with their GenDrive fuel cell systems, counting giants like Amazon and Walmart as core customers. While that legacy material handling business provided a solid foundation, the actual scaling mechanism moving forward is their utility-scale electrolyzer business, exemplified by massive global projects like their 100-megawatt system at the Sines Sines refinery in Portugal, or their recent front-end engineering design awards in Canada. The core fundamental tension right now lies in the massive capital required to maintain this infrastructure versus the accelerating demand coming from an unexpected source: artificial intelligence data centers. Big tech firms are realizing that traditional electrical grids cannot handle the exponential energy requirements of next-generation AI workloads, and they are actively looking for alternative primary and backup clean energy sources. This massive structural shift has positioned hydrogen fuel cells as the primary candidate for clean utility-scale backup power, which is exactly why the company recently executed a major $132 million agreement with Stream Data Centers to optimize clean infrastructure. This development changes the narrative from a speculative clean energy bet into a tangible infrastructure supplier for the modern digital economy, separating the company from smaller pre-revenue competitors that lack a physical manufacturing footprint. Let's break down the realistic future scenarios for this equity over the next 12 to 18 months, because the gap between current market expectations and actual commercial execution is bound to close. In the bullish scenario, the company continues its aggressive margin recovery, hits its target of positive adjusted earnings before interest, taxes, depreciation, and amortization by the final quarter of this year, and successfully secures its pending Department of Energy loan guarantee to non-dilutively fund its next phase of domestic plant expansions. If they execute on this path, the current share price will look like a historical anomaly, and the stock could easily re-rate toward analyst consensus targets, which sit well above $3.25. Conversely, the bearish scenario cannot be ignored. If project commissionings face extended regulatory delays in Europe or the US, or if the domestic hydrogen production facilities suffer unexpected operational downtime, the cash burn will accelerate, forcing management back to capital markets for a dilutive equity raise that would suppress share value. Please take a second to comment below with exactly how many shares of this stock you are holding in your portfolio right now, or if you are completely avoiding the hydrogen sector until the macro environment stabilizes. Tracking these metrics across various investing platforms, whether you manage your capital via specialized Fidelity mutual funds, use automated solutions like Schwab Intelligent Portfolios, or take a hands-on approach through active online investment accounts, reveals that the clean energy market is completely bifurcated. The investors who are winning are the ones who can separate past corporate missteps from current operational milestones, recognizing that a company under new operational leadership is fundamentally different from the one that struggled with supply chain bottlenecks 2 years ago. When you synthesize the entire picture, the contrast between expectation and reality becomes glaringly obvious. The market expects a perpetual cash-burning machine that is too early for a nascent hydrogen economy, but the reality shows a company expanding its revenue by over 20%, rapidly closing its margin deficit, and shifting its index classification into growth territory while actively deploying commercial-scale electrolyzers on multiple continents. It's an asset that demands a sophisticated understanding of corporate turnaround dynamics and structural energy trends, far removed from the simplified hype cycles that drive temporary retail momentum. Whether this stock ultimately delivers on its 2028 profitability targets will depend entirely on disciplined execution and strict capital management. But for now, the data suggests that the underlying business is making quiet, foundational structural progress that the headline stock price has completely failed to reflect.